Hi everyone, this is Starpath Academy Storytime. In this video I will give a brief introduction on how to serve hyperinflation and a taste of how some people got rich during hyperinflation. This needs to be a series, and I'll give probably another one video or two videos presentation on sort of what my observations were looking back on what happened in Romania during the hyperinflationary period and sort of what I learned from that experience and what I'm expecting. But of course that could be just my own points of view. But in this video I'll give a brief introduction. So before we even begin, I want to let you know that I was thinking long and hard about how to phrase and how to construct this video. And the main reason is that during the hyperinflationary period in Romania in the 90s, how most people got rich was actually on the misery of other people. That was almost the norm. In these situations that becomes the norm. So unfortunately, telling you these stories, I was thinking that in my head, well, maybe I'm training you to become rich on people's misery, right? But if I don't tell you, or if I don't tell the masses, then what happens is people are in the knowledge of this. It's not ultra secret, right? So large entities, large organizations, companies, and a lot of wealthy people will be doing it anyway. You know, they don't need to listen to my YouTube videos in order to do that. So I was thinking, well, if I let you know of what could be happening in a hyperinflationary scenario, I'm actually creating more demand, right? I'm actually creating rivals or competitors for them. So the more people would be in the know, that means more people would be chasing the goods of people who are forced into selling their own investments or properties. So in hopes of that, they might actually get a better deal than instead of just having these huge sharks in the water, right? And the people losing their houses or their property. Technically, if everyone would be in the know that this scenario is hypothetically coming, then nothing would happen. Nobody would lose anything because everyone would be prepared for that, right? In a general good market, you know, in a general good economy, this is usually not true, right? Because you have a company, you create products, and you're getting quote unquote rich by selling your products, and then people consume it. Maybe they get more productive. Your product is better than your competitor, and so on, right? You're actually providing value and then they provide you money, right? That's how in a good economy people should get rich, right? Of course, that's not what's happening, or that's not what's happening, but that's the basics, right? Well, in a hyperinflationary scenario, just like in a crash scenario, right, like in 2008, the easiest thing to do is actually just pick up other people's property, right, their life savings, right, if they were not prepared and you were prepared. So in essence, you're taking a bigger slice of the pie. So there's the pie fallacy where people think, well, just because you're getting rich, somebody else is getting poor, right? And that's not the case in a good economy, right? That should not be the case in a good economy because you're providing products. But in a crash or in a economic downturn, that is somewhat true, if not completely true, because there's no economic activity. So there's a certain number of houses, there's a certain number of assets, and by somebody getting rich, most likely on the other hand of that trade, somebody's getting poor. So hopefully if you share this information with a lot of your friends and family and so on, enough of you can compete against the remaining assets that remain in a hyperinflation against some of these big sharks. And to some degree that is already happening. Because if you take a look at BlackRock and some other major companies that are buying up houses, you're not able to buy up houses at market price, right? Again, neither are you. But actually they have to bid up the price of your house to 25-50% sometimes, right? So that's good for the people who are selling their houses. Maybe they lost their jobs, right? And now they are forced to sell their houses, and now they're getting a somewhat better price. I'm not saying you should sell your house if you can afford to live in there, because when prices are up and you're chasing them, I have actually friends who sold their house and were looking into buying a different house, but they cannot move back into the same neighborhood anymore, right? So now they're doing something else and probably won't be able to buy a house for, definitely not the house that they were planning to buy, right? So I can tell anyone my opinions, and they are opinions. I'm not giving advice. I'm not a financial advisor, but if nobody listens or they don't listen, what can you do, right? So hopefully you listen and you talk with your investment advisor, and you come up with your own conclusions. This is just for educational purposes, and you'll do your own research. Now back to the topic. The closest thing that we can relate to, right, and you probably have in memory, is the 2008 crash, right? That was actually a housing crash, right? Of course, many other things, but anyway. What happened then? How could you have, got rich in that scenario? Well, staying on the sideline, right? You're looking at house prices going way up, and then you're waiting for that crash. You have a bunch of cash on hand, and then it crashes, and then you pick up stuff on the cheap. And some people might have saved a lot of their lives in order to be able to afford a house, right? And if you were staying on the sideline in cash, you could have picked that up. It is what it is. In a hyperinflationary scenario, this is almost true as well. But it's sort of in reverse, where your cash is diminishing. In 2008, the house price was diminishing. In this hyperinflationary hypothetical scenario, your cash is losing value. So actually everything is going up. I can't even count how many comments have I read, Romanian people in my videos or some other videos of hyperinflation, where they were telling that, I remember my father and mother was saving up for a house during that time, and eventually they were able to buy a shoe with that money, or a bicycle, or another one said actually a television set, which I can relate to, right? If you heard my story about the relative. So that's what happened. You should ask people who went through these hyperinflationary scenarios. Right, so their cash value was dropping. Their purchasing power was dropping. But the general idea to stay on the sideline and let the market do something, and you being able to pick up an asset, is a good idea. But the question is, what can you be in? What is that sideline? Right? In our case in Romania, it was other currencies, because our hyperinflation was a local hyperinflation. That means, it wasn't technically local. A lot of other countries, Soviet satellite states, went through similar scenarios, similar problems, roughly the same period. But there were other Western European countries and the United States and some other countries whose currency was not affected at all. They had their own markets, right? Different markets. So if in that sense, in the 90s, staying on the sideline meant that you were in Deutschmark, German marks, or American dollars. And then Romanian lei in purchasing power was falling. And that actually pulls a lot of industry with it, the Romanian industry, right? Because Romanian people are no longer able to purchase the stuff that these companies are producing, right? So as long as they didn't have 100% export market to Western European countries, then they were crashing. Many got bankrupt. Now, technically, you could move in and purchase stock in these companies or purchase these companies outright, right? But maybe that's a good idea, maybe it's not such a good idea. You have to pick the industry, you have to pick something else, right? Location and so on. Houses again, they were actually rising in price, doubling. But compared to a foreigner's view, from a foreign perspective, somebody on the sideline holding euros or German marks during that time, actually Romanian houses were falling a lot. They were falling a lot. To give you an example, and this is, I'm not promoting cryptocurrencies in this video, at least. For you to understand this is, let's say you are standing on the sideline in Bitcoin, right? 2 years ago or a year ago, maybe. And everybody is seeing appreciation in housing prices, but if you're in Bitcoin, housing prices are dropping for you compared to your currency, right? So that was the similar scenario in Romania in the 90s. If somebody was holding a lot of German marks, housing was increasing for everyone else, but it wasn't for you. So there's your comparison. There's another way how to get rich in hyperinflation. Is to actually to short your own currency. And we can get into what shorting means, but technically a short, let's just say a very simple example is you want to short, corn. Maybe you're producing corn, you want to short corn because you want a position where you'll be able to sell your corn at an exact price, and you don't want to be affected by market fluctuations. So maybe you short corn, or you do something else, whatever. So in this case, shorting means that you borrow X amount of corn, you immediately sell it on the market right now, and you take that cash, sit on the sideline with it, right? And then corn starts dropping in price. Now you buy back the corn and you pay back your debt in corn, and the amount that it fell, you take that cash home with you. In very basic terms, that's shorting, right? Shorting usually is done with the leverage, right? So you actually borrow money in order to short something. You're not using your own money. Maybe you leverage it 1 to 10, 1 to something, whatever. Now, how would you be able to short your own currency? Not on the forex market. You could of course do it in the forex market, but what good that would make if all the currencies are falling at the same time, well, shorting currency would actually mean in this time buying assets with leverage. I'm not giving this as an advice. I'm just giving you hypothetical scenarios, right? So let me give you an example, right? Your currency is falling and maybe gold or some other assets are appreciating, right? You borrow some money, you buy gold goes up, right? You sell the gold and you give the money back, right? Well, this is very, very risky, right? Because markets can act irrationally for a long period of time, and you might not be able to hold that position for a long time if you have a lot of debt. But actually there's a mechanism to do this, not with gold, but with houses. It's called a mortgage, right? And it's leveraged. Even if you're buying investment houses, right? You put down 20%, 25%, so that's your leverage, 1 to 5, 1 to 4. You're actually borrowing money in the present, and then just like how the guy was borrowing corn, you're borrowing money, right? You're shorting money, and then the value of money is going down, and then you'll repay it back in 30 years, right? Or you start repaying back immediately, but by the time you pay it back, the value of money has lost a lot. So in hyperinflation, you can short money by taking on mortgages. Should you not? Talk with your investment advisor. But you can now guess why some of these big companies are doing it. That's what they're doing. They don't care necessarily about the houses, right? they're shorting money with an asset, and they picked houses because, houses are whatever. I don't know why they picked it. Well, they will have value in 20 years as well. That's why they picked it. Okay, so two ways of making money is staying on the sideline in something completely else, not affected by hyperinflation. And then when there's a lot of misery in the market, you're picking up assets on the cheap, right? And the second thing is actually shorting the currency, right? Now, both of these things were different in Romania in the 90s than what could be happening now. Because Romania was a local market, Eastern European market. So you could have shorted Romanian lei, right, on the forex market against the United States dollar. You would have made a lot of money, right? But what happens if it's a global thing, right? Or you could have also, stood on the sidelines in German marks and then pick up Romanian assets on the cheap. A lot of foreigners did that. Eventually, my family kind of caught on that, hey, this is a good strategy. And we were actually lucky enough where my father's company was by German investors, and there were periods of time where his salary and some other businesses that we did, we were able to get foreign currency as payment, right? And that was really good, because now if we were actually saving foreign currency, we were truly saving it, right? Whereas the Romanian people who would be getting their salaries or government coupons in Romanian lei, even if they were saving that amount, that was falling, right? So a lot of people just started pricing things in foreign currencies, right? To kind of peg it to something, right? But you can peg prices to something, that doesn't necessarily mean that actual other people can buy it. So the people who would be able to buy it was actually who were standing in the sideline in something else. And that's what we did. And during hyperinflation, we were able to pick up a couple of properties. And then those became actually fully paid off. And we were able to rent it. And then a storage place as well. Now, we didn't really, get rich on it, but it was enough for us to get out of crushing poverty. So, and even then, we had to give for the apartment that was purchased. I remember one was around 20 or 25% above the asking price. Because by the time we kind of caught on to this, there was a lot of foreign investors in the market as well. Now, Lucky, who actually sold the house, we knew them, and they immediately purchased a house on the other side of the town. So because if they would have held on to cash, that would have diminished, and they would have gotten a raw deal. But they immediately purchased another house. So they actually were smart, and then they did something else as well with land as well. But anyway, that's how eventually we were able to get out of poverty, and going from counting potatoes if we can make it this winter or not to owning rentals was that we figured out the sort of waves, how hyperinflation is happening, and then just before a next wave of real estate, we had a good opportunity because we were able to save foreign currency and get foreign currency and then move into real estate just before the wave. So that's how we did it. But on the other hand, and we actually were able to purchase these houses or apartments in cash. So during hyperinflation, it's unlikely that a government or bank would give you mortgage. It's because at that point they're caught on, right? They're not going to lend you money for 30 years. No. They might do that prior hyperinflation, right? They might lend you money now, but then during hyperinflation, if their end of the contract is kept, then you're paying them off in diminishing currency. So another example was the example of my father-in-law, who had purchased the house prior hyperinflation, and he had a mortgage on it, right? And the mortgage amount was around. We talked about this, and he mentioned 100,000 lei, and this was prior hyperinflation. Eventually, 100,000 lei was very little, right? But during that time, salaries were, I think, around 2,000 a month or some month. I have to catch up with him about some exact numbers, but you can probably translate it into a modern scenario where maybe you owe $100,000, $120,000 on your home, and you have a $2,000 salary, something like that. It would roughly equate. No matter what country you are in, usually if it's a regular market, regular economy, the median income and the median house, it usually is within a ballpark, right? It goes up and down depending on the country and depending on the location, right? It's could be very different, but it's usually in a ballpark. So that is sort of his numbers, what he remembered, and what I remember from what he told me. So eventually he got a job in Germany and went and was able to do work for his friend in Germany who was living in Germany at that time. He moved prior, probably during communism or something like that. He escaped somehow, and he was able to work for his company in Germany. And when he came back, he was able to pay off his debt for the house with his less than 3 months salary, right? So not Romanian salary, but his German salary, he came back with, and he said that out of 3 months salary, he even had money left over. All while real estate was going up, and up in Romanian lei. Okay? So that's why I told you in previous videos that you should not measure things in dollars. You should measure things in other things. And in this case, the other thing is a foreign currency, right? But if hyperinflation would be happening in the whole hemisphere, it would have to be something completely different. Maybe cryptocurrency, maybe gold, maybe something else, right? It has to be something else. Maybe it could be Google stock. So, or other stocks. I don't want to promote Google. I don't know how Google stock will perform. But you have to think of what that sideline could be for you, right? Okay, so now I want to take a quick look at housing prices. Lumber, everything is here. All right. So this is the Case Shiller National Home Price Index. And I just want to let you know like how I'm seeing this chart. I'm not a financial expert. I'm not giving advice, right? But as you can see, house prices, of course, were rising up until sort of the 2007, where they were probably overpriced, right? And then the recession happened, the crisis, and house prices fell, right, during this period. So economic hardship, house prices are falling, right? And it fell again some more, and then eventually it started rising, right? Now this yellow here is the toilet paper virus crisis happening, right? So how is this different than the previous one, right? House prices was actually falling here, yet if you take a look at it here, house prices are increasing, and not even at the same rate, right? It's increasing it's accelerating basically. So how could that be, right? How come people are losing and the economy is on a lockdown and so on, yet house prices are increasing, right? Well, maybe they are not increasing if you would be looking at it from gold's perspective. Maybe they are actually falling, right? But just in Romania's scenario, it was increasing for the people who got their salaries in Romanian lei, right? But for foreign investors, it was falling. Now, I'm not sure if foreign investors, what type of foreign investors you would have to be, because this is the United States dollar we're talking about, the world reserve currency, right? So let's take a look at gold chart, right? If you take a look at this period, gold went up significantly. So that's why I'm saying if you would be standing in the sideline in gold during this time, house prices would be actually falling for you. And then we have the price of lumber here. So in hyperinflation, I mentioned waves. In I think my very first video, I mentioned waves and how we kind of figured out waves. Especially looking back, it's always easier to know what happened, right? And then analyze charts and so on. But I mentioned that it usually starts with raw materials, because raw materials has the most potential. Raw materials will be raw materials in 5 years, in 10 years, in 20 years, it doesn't matter. And as long as we have civilization, these type of raw materials will be needed, right? So it's easy to stay in the sideline in raw materials, right? So even people who are not interested in buying lumber, they could see lumber or raw materials as quote unquote staying on the sideline, right? Houses are good, real estate are good, but they are local. So every real estate is local. It's a local market. As things progress during hyperinflation, you can see how things are moving and shifting, and then you can pinpoint on the map a good location where you would want to buy a house, right? But in order for that, you actually have to get into hyperinflation a little to be able to predict what's happening, because if not, you might be thinking, well, hyperinflation is happening, let me buy a downtown New York apartment building or apartment, right? And that might not be a good scenario if people are moving out of big cities. So investors and people who want to get rich during hyperinflation stay on the sideline and then don't immediately go into real estate, because real estate is a local market. Now for waves is, if you're familiar with Elliott Waves, then this should not be news to you, but just in case, I'm not going to go into detail for Elliott Waves, but if you take a look at a chart here, right, and it's hard to see Elliott Waves while they're happening. It's always easier to see at later point in time, but prices tend to go up in waves, and usually there's the first wave, then a pullback, second wave, a third wave, fourth wave, pullback, and a fifth wave. So that's 1, 2, 3, 4, and 5. And I'll link a couple of videos in the description that kind of describe why this is happening. It has to do with market psychology, and these are sort of, it's hard to kind of find the waves while they're happening, but after they have happened, you can put this pattern on any chart basically, right? And then prices move down in 3 waves, something like that. So that's, I believe it's called A, B, and C. And these are the impulses. So let's start with just looking at the upward trend. The big upward moves are the impulsive moves, and then a pullback, impulsive move and pullback, right? And this is true during hyperinflation as well. Don't, just because prices are increasing, that doesn't mean that people don't think, oh my god, it's now it's over and it's gonna stop, and then people sell, or even if they don't sell, the market kind of stagnates. So the turns might not be this sharp, right? But this is true to everything in hyperinflation. Everything gets its turn, basically, so to say, in hyperinflation. And I mentioned usually it's raw materials first, then stuff made from the raw materials, eventually housing, then food, and so on, and almost the very last thing, it's salaries, and even they will increase, right? So let's just say this would be raw materials for buildings, right? Copper, wood, and so on. Then housing would start. Eventually housing starts to increase, the same thing happening, right? And this would be houses, right? very similar patterns. Of course, they're not always this clean, and the waves could be much more messy, but you kind of get what's happening. But there's a delay between here, right? And then food prices would be increasing. Right, something like that. And then salaries. And usually salaries is not as steep as the rest, and it's always late. And there's a delay here between houses and salaries, right? And I kind of over exaggerated the delay here because I put food in here, but usually what happens is the second wave of the housing, let me redraw this a little bit. So let's just care about housing. And then salaries. Something like that. Now, the timing is not always exact, but just logically speaking, the second wave of the housing cannot start, or usually doesn't start, until salaries have increased. Because who are buying the houses in a normal scenario? It's people, right? And prices of houses might actually have to come back before salaries increase. Before the second wave of housing starts again, right? Because salaries needs to increase because people are buying houses, right? Now, what's happening in the US, I kind of stumbled me as well. Like, it kind of made my models to be updated, because I wouldn't have thought that big companies would be moving into regular single family homes this fast and with such force. You know, I've seen similar things in Romania with foreign investors, but usually they're actually late. They're late to it, because as a foreign investor, you might not know, which city is a good city to buy houses in Uruguay, right, or Argentina, or somewhere else, right? So they actually do their research, they move, and then kind of make it up. But now, I guess these huge companies are domestic, and they already know what they're doing. So I would have predicted there's a bigger delay, right? But one thing that people are talking about, and this is inflation adjusted, I believe. One thing people are talking about the houses, that house prices are increasing because there's not enough inventory. All the houses in the United States are in the inventory. If you would be making a good offer, houses are not in the inventory because nobody wants to sell it, because it's an appreciating asset, very fast appreciating asset, and you're not giving a high enough offer for them. as soon as you would give a high enough offer, then it would be on the market immediately. So everything is on the market always. It's just, it doesn't have a sale sign in front of it. Just the same thing with wages. People are complaining about job vacancies. Look at that chart shoot up, right? And people are saying, well, people are not, coming back to work. Well, of course they're not. Because you're not giving them high enough wages. If you would be giving them high enough wages, then they would most likely be coming back, right? And of course, I know about government and coupons and almost UBI. We're just not calling it that yet. Whatever. That plays in hand, right? Government is in the market. So you're actually competing. If you're a small business, you're competing against government in order to hire people, right? So I understand that part, but as a market perspective, they're not taking on jobs, because in order for them to go into these jobs, you would need to give them higher salaries. So in this sense, the small companies are getting crushed. Is it planned? Is it not? I don't know. But that is what's happening, right? Now, what happens if this number goes down? And this number, which is wages, increasing, right? And of course, you can see these last couple of years, what happened here, right? Let me see a 10-year chart. Here's 2008. Here's 2020. If we will get back to the hypothetical of hyperinflation, I was telling you about salaries eventually increasing, right? What will that do? In my opinion, not the financial guy. Well, maybe I am a financial, but not an advisor. I'm not an advisor. You do what your advisor tells you. What will happen? It's easy. Prices will increase again. And the loop starts over. Now, what did I leave out? Two things that you guys have been asking me a lot. Gold and silver and cryptocurrencies. Right? So let's take a look at gold and silver. Here's gold. And you're saying that gold needs to increase. If you're taking a look at other commodities compared to lumber, lumber went up 300%, fall back down. By the way, for an Elliott wave, the first fallback is usually 60%. And if you want to take a look at measure lumber, then you kind of 50% would have been 150 from 300. It's over 50. We'll see what happens. It might go further down. I don't know. Anyway, so if we take a look at gold, compared to lumber's increase from here to here, gold was actually stagnating during that period of time. But gold is both a commodity and a monetary asset, right? So the monetary asset has already kicked off way back. So they say gold increasing is the canary in the gold mine, or the coal mine telling you, hey, there are problems because people are moving into gold. So if you look at it, like, things were increasing from 2004, right, 2005, right? It already forecasted, it already played its forecast, right? What will happen now? We're not sure, but if you take a look at, if we add lumber to this chart, and we take a look at a 25-year chart, right? Gold was increasing way before. If we look at percentages there, it already forecasted the problem, what, 15 years ahead. But markets can be irrational for a long time, right? So actually, gold didn't do well in this scenario. It might actually fall back, you know. We'll see how much. I don't think that much, just because of big international purchasers. But what also happened in the Romanian experience during the 90s was that gold went up a lot as we were getting into hyperinflation, and then it went underground. The price was just not there. It was never sold or bought. And then it went up again as we were leaving hyperinflation. But as I mentioned, hyperinflation happens in waves. And look at gold. What I'm expecting is actually to be one of the last things. One of the last things by the time a lot of investors think that the market has gone too crazy and the house prices are too much even compared to the salary, and then they will be looking at other long-term investments, those millionaires and billionaires, when the stocks might be crashing because the salaries were increasing too late in the cycle. If there's a lot of time between these cycles, that can kill companies, because people will not have the money to purchase the goods that the companies are producing, right? So this is usually houses, but there are also stocks in here, which kind of could be before houses, somewhere here. If that increase is a lot, that in time, that time frame is a lot, that means companies are producing stuff, but actually they're not making a lot of profit. They're just going up in a hot air balloon in price. The stocks are, but the purchases might be slowing down. So usually government wants to kind of pull this time frame to be a shorter, because if it's too long, then the stock market will be crashing. In real terms, it might be going up nominally, but actually it's getting bad and bad, worse and worse. So eventually, when base commodities went up in too much in price compared to minimum or average salary, housing went up too much in base or minimum salary, then in my opinion, that will signal a gold increase, right? And then it can go up a lot, because as I was telling you the example of the homestead and the gold chain in the gold video part 1, we didn't even knew what was the actual price in some scenarios, and eventually people bought into just to save some purchasing power, and they would have almost purchased it at any price. Could this happen? Probably. I don't know. There are other players in the game now, such as cryptocurrencies and so on. Now we have to see, will cryptocurrencies actually act like stocks or act like gold? So are they really stocks? Are they monetary assets? Are there something else? There's no historical points that we can take a look at for cryptocurrencies. One thing that we know is that there are hyperinflations happening right now. There are hyperinflations happening in Lebanon, in Venezuela, and other countries as well. In these scenarios, cryptocurrencies help because they're actually a global market. So it provides, just with having access with a smartphone, it provides a Venezuelan or someone from Lebanon access to a global market where hyperinflation is not happening. So when somebody from Venezuela is buying or selling crypto, that other person could be in Germany or in Japan, right? Where they're not experiencing hyperinflation, or they don't think so yet. Right? So in that sense, it kind of plays into that hand of staying on the sideline, right? Because it's not affected. Now, what would happen if multiple countries, major developed countries, would go into hyperinflation in the same time? We'll have to see. But will it be, a store of value, or will it be sort of like stocks that people in some of these scenarios, what happens is people try to grab their gains immediately, right? And then put it in something real that will have value after 5 years, after 7 years, or whatever hyperinflation went through. I'm not sure. I don't know. I would like to, have a debate about this, see arguments and counter arguments for this. I can see both sides, but I'm not going to speculate on this right now. What I'm searching right now is assets that would not be affected by the currency falling, right? And there are a lot of good suggestions, and I've talked about the history of precious metals and how they can help, but that is for saving long-term wealth and not for being in and out of different asset classes, in my opinion, because I'm not sure if you want to sell your gold during hyperinflation if you don't know how long the hyperinflation will last. It's easy to talk about these hypotheticals, but it's sort of like when a whole country goes into depression. It's very hard to spend something that is still going up in price to purchase something that is still falling in price. And if you don't believe me, then sell your gold or sell your Bitcoin and purchase real estate in Detroit. Some of the commenters told me that during the Weimar times, a house was an ounce of gold. Could be true, right? I'm pretty sure it is. But I'm pretty sure I can find you a house in Detroit that you can also purchase for an ounce of gold. So you have to have longer perspectives and position yourself and make up your mind before hyperinflation. That what are you planning to purchase at what price? Thing against thing. You say, if the apartment price in downtown, Jacksonville will go to X amount of gold coins, then I will sell my gold coins and purchase that. And you will most likely not catch a market bottom or a market top in gold or whatever, but you kind of made that decision for you, and then now you're on the other hand and you're waiting another 3, 5, 10 years maybe, hopefully not that much, on the other side of the of the equation, basically, right? So you have to pre-position yourself in these assets. It's very hard to play the waves. I'm not even saying play the waves. I'm not even planning to play the waves myself. But for me, with my experience, I can see it as an indicator. And, I was able to move into real estate, and I'm waiting actually for a drop. And then that might spook the market, it might not. The drop might not even happen, right? If the drop happens, then I'll know what to expect. And also what to expect from government. However, the hyperinflations could be pre-running, a deflationary period could be pre-running the hyperinflation. So there are scenarios in history where hyperinflation is pre-run by a deflation first, because a lot of things can happen, but in the calamities or whatever happen, people actually start hoarding cash first, because that's what they know, right? We drew some charts, we made some sophistication here and there, but the average person, for them, cash is safety, and it is, right? So they might actually start hoarding cash. Also, if a very high inflation is starting to happen, banks might not want to lend, or definitely not long term, for 30 years or something like that. And I can tell you what they usually come up with in some of these countries like Romania. You don't get 30-year mortgage there fixed. The first 5 years is fixed, then the rest it's floating or something like that. There are different scenarios and different things that banks come up with, or sometimes it's like government-backed stuff. And yeah, we can talk about hours on what could happen, but just know that if banks stop lending at the rate that they do, there could be a deflation happening, and then government needs to think up what they will do in that scenario, and knowing the histories and the trends that they follow, then sometimes they overprint to make up for that, and then hyperinflation could happen like that. We don't know, but we can talk about it in the next video. If you are not following me yet, then please take a look at the description of the video for my alternative channels, and you can always find me at buymeacoffee.com/StarPathAcademy. So thank you very much for watching this video.